Importing goods into the U.S. just got more expensive, and exporting them to other countries is about to cost more as well. President Donald Trump imposing 25% tariffs on all goods coming in from Canada and Mexico, our closest trade partners. Also imposing an additional 10% tariff on China on top of the 10% one added back in February. Now Mexico, China, and Canada are all planning to retaliate. So what does this mean for consumers? Joining me now to discuss, we've got Paul Gruenwald, Chief Global Economist at S&P Global Ratings. Paul, it's great to speak with you. Help me break this down for consumers monitoring these headlines coming in. Is the tariff tit for tat that we are continuing to see something that is actually going to hit consumers' wallets in the near term?
Yeah, thanks, Madison. Great to be on the show. Yeah, the first issue to think about with the tariffs is who's ultimately going to pay them. Obviously, tariff, but we try to look historically who's paid these, and we keep coming back to the same answer, which is ultimately it's the consumers in the the tariff issuing countries. So in this case, it looks like most of the tariffs are going to be passed on to U.S. consumers. So when you put that together, we've got a revised forecast now that's got a bit lower growth, a bit higher unemployment, and a bit higher inflation reflecting that.
And where does that leave your outlook in terms of the likelihood of a recession?
Yeah, in the U.S., it might be kind of marginal, maybe 20 basis points, because the U.S. is a relatively large economy and it's not very trade dependent. But our trading partners, Mexico and Canada, they are likely to go into recession with reductions in growth on the order of 1 to 2 percentage points. So again, kind of on impact, it looks manageable for the U.S. What we're really worried about is this uptick in uncertainty. And if that starts to affect firms' investment decisions and consumers' spending decisions, then we could be in for kind of a bumpier ride in the U.S.
Yeah, I'm fascinated by this idea of whether or not we can sort of talk ourselves into a recession by talking about policy risk, by increasing fear in the market. And we're seeing a key fear gauge hitting a record high this morning as well. Have you seen that happen throughout your career, this idea of uncertainty and fear about the market leading to a recession?
It's pretty rare. We have a couple of recent examples where the Fed's U.S. policy uncertainty index has spiked. One of them was at the beginning of 2009 when we entered the global financial crisis, and the second one was March 2020. When we entered the pandemic, and policymakers were understandably at a bit of a loss back then as to what to do. The index spiked again in 2025, January and February. So if this does indeed lead to a pullback in spending, it would be kind of an own goal. It doesn't necessarily mean recession, but it's kind of an avoidable slowdown in growth. We'll be revising our forecast later this month, but we've definitely come to the view already that the downside risks to our baseline soft landing scenario have risen.
And how are you thinking about the Fed moving forward and whether or not they will be more willing to take policy from the White House into account when they're deciding whether or not to cut rates this year?
Right. Well, Jerome Powell's been pretty clear that the Fed's independent, right? It's independent within the government. It's not some external organization. It's part of the government, and its mandate is set by Congress. But I think what's interesting about the Fed is most of us economists were thinking that going into this year, the Trump administration would try to juice up growth a bit. Inflation expectations came up. So we took a couple of Fed rate cuts off the table. We went from 3 to 1. Now with this new downside risk on the uncertainty we just discussed, we can see the bond markets reacting, the 10-years down to 4.1, 4.2. There's a possibility that with the growth slowdown, those Fed rate cuts might come back on the table. That's not what you want, because that would be signaling a serious slowdown in growth and, possibly a recession. Also would be a weaker dollar. So that's kind of the trade-offs we're looking at right now, whether this uncertainty is really going to move the macro needle downward in a big way.